we're going to talk about pivots versus swings for supply and demand trading. For the purposes of this training and for the definitions, we're going to be using some abbreviations. So this is a list of the abbreviations that we are using. Example, PH, pivot high, BH, base high, HH, higher high, LI, leg in. So that's an example and shows you some of our abbreviations that we're using. So let's start out by looking at the definition of pivots. A pivot high is a candle whose high is greater than the highs of the candles which surround it. And the strength or period of that period high is the number of candles that must have lower highs on either side of the pivot high. So the inverse of that is a pivot low, and it's a candle whose low is less than the lows of the candles which surround it. And the period of strength or strength of the pivot low is the number of candles that must have higher lows on either side of the pivot low. Okay, so here's the pivot high. You can see here's the high of the candle, and the candles on either side of it have lower highs. And then here's a pivot low, and you can see the low point here. And these have higher lows on either side of this pivot candle. So let's talk about the definition of a swing. Swing high is a candle whose high is greater than the highs of the candles which surround it. Swing highs must have at least two candles on either side of it that have both lower highs and lower lows than the swing high. And these two candles do not have to be adjacent or next to the swing high, but they must appear before a candle with a higher high than the swing high. The inverse of that is the swing low. So it's a candle whose low is less than the lows of candles that surround it. The swing low must have at least two candles on either side of it that have both higher lows and higher highs than the swing low. And these two candles do not need to be adjacent to the swing low, but again must appear before a candle with a lower low than the swing low. So let's look at a picture of that. So here is an example of a swing high, and what I did is I actually put numbers 1 and 2 showing you which candles make it qualify as a swing high. So you can see those candles here, and the same thing to the right. Here's your 1 and your 2. Those are the candles that qualify. Then if you look at the swing low, again, I numbered the candles, and this is pretty straightforward. They're the adjacent ones, 1 and 2 to the left and 1 and 2 to the right. So now that we've talked about the definition of swings and pivots, what does it mean? So these are points where price changed direction. So for looking at supply and demand, we know that for price to change the direction, there was an imbalance there. We don't know how large that imbalance is, and we don't know how much remains. So this is what swings and pivots tell us about price action and what supply or demand may be left behind. Another element we need to consider when we are looking at a chart is not only swings and pivots, but we need to look at the basing candles and the bases that are created. So when we think about a basing candle, we're talking about a candle where one or more of the immediately following candles closes between the high and low of that candle. So these candles are trapped between areas of supply and demand, and things are relatively in balance, and that is known as basing. And we call those candles adjacent bases. So a base candle is a candle which closes between the high and low of a basing candle which precedes it. And the base itself is a basing candle followed by one or more base candles. And that base ends when a candle closes above the high or below the low of the basing candle. So let's talk about base high and base low. Base high is the area of supply that is left when price breaks out of a base to the downside. So it's going lower. A base low is the area of demand that remains when price breaks out of a base to the upside. So let's look at a picture of this. Here's an example. There's a tool here that I'm using, and it shows unbroken base highs. Those are the red ones. And it shows this kind of purplish color when a base is broken, because you can see price closed above it here with this candle. And then you've got a broken base low, and that's that kind of forest green color. And you can see it would have been broken probably by this candle right here. And then you have unbroken bases. So these, the base lows are this bright green color, and as I said, the unbroken base highs is the red color. Now, here is a base that is currently actively being formed. And so you have the first candle here that's marked by the green and red, which is your base candle, okay? And then you have the basing candles that are inside the high and low of the base candle. So this is an example of an unbroken base. Price is actively trapped right now because it has not broken higher or lower than the base candle. And you can see we've got these little yellow dashes on the candles that start the base to help you see where the bases start. So I changed the indicator so that it shows every base candle. And as you can see here, I've got the purple lines here. And so this is a base candle because this candle right here closed inside of the range. But this candle here is also a base candle because this candle closed inside the range. So you can see that you can have multiple nested basing candles and bases within a single base. So now you understand how bases work and the basing candle and the roles of base highs and base lows. Now that we understand about bases, we're going to talk about the leg in and the leg out of a base. So a leg out is the first candle which closes above the high of the basing candle which started the base, or below the low of the basing candle which started the base. The leg in the event of a downtrend, is the last candle before a base which closes below the previous candle's low. For an uptrend, it is the last candle before a base which closed above the previous candle's high. So we have some bases drawn here, and you can see that this candle here is a leg. You got a leg in, you've got your base, and you have your leg out. Now this is also doing double duty as a leg in to another base. Okay, so you've got your leg in, you've got your base, and then you've got your leg out here. So that's showing you on like demand bands. So then let's look at it on the flip side. So you have a leg in to a supply band, you have your base and your leg out. And again here, this leg out is also acting as a leg in, and you got your base and your leg out. So in this case, the leg out is also acting as a leg in. So they can do double duty. So that will shows you about the leg in and leg out to the base. And we will be talking more about the importance of those leg ins and leg outs and how they might help us choose better areas of supply and demand. So here is a chart in which I have our Ultimate Chart tool loaded on here, and you can see that the tool itself has the ability to mark the swing lows and the swing highs. It can show you the base highs and base lows, as well as you can show the broken base highs and base lows. And you can see here that we have the ability to indicate the base candle that starts the base, and then this is a supply band, and you can see that this orange box is actually marking the origin, so you know where the leg in and the leg out is for that base. It's just another visual to help you understand what created that area. So if you'd like to learn more about this, you can check in the information below in the description. The basing candle functionality is only available in our Ultimate Edition, but the swing highs and swing lows is available in our Standard and Standard Plus, as well as the Ultimate Edition. Happy trading!